Hi, everyone. This is Tony D'Amico with Fidato Wealth. Thanks for joining me today. And today I have a very special guest to interview, Christian Newton, who is a vice president at Dimensional Fund Advisors, one of the institutional managers that we use in our portfolios. And Christian has been with Dimensional for over 18 years now. He's worked in their Los Angeles office, their Austin office, and now in their Charlotte office, and he works in their global client group. And Christian helps financial advisors leverage Dimensional's capital markets research and how to apply that both to portfolio management and the management of an advisory firm. So Chris has a vast amount of experience. Christian and I rather did a podcast a couple years ago. Time flies by. So excited to have this conversation with him today. And a little bit about Dimensional. They were founded 41 years ago, and they've been working with advisors for over 30 years. They manage about $650 billion of assets. They have 1,400 employees, over 14 global offices. Another really important fact about Dimensional is that the industry over a 20-year period, only about 17% of both equity and bond funds outperform their benchmarks. But during that same period, 85% of Dimensional's stock and bond funds beat their benchmark. So they have a great management team, management process and philosophy, and a great track record. So we're really excited to work with Dimensional. Another really important part about Dimensional is that in the midst of the global financial crisis that happened between 2008 and 2012, the industry had over 500 billion in outflows. So about $530 billion of funds that came out of monies that came out of funds. And obviously during that time period, you want to be doing the opposite, right? You want to stay disciplined. You want to be buying while things are lower. During that same period, Dimensional had 34 billion in stock mutual fund inflows during that same period. So that's really a testament to both, I believe, Dimensional funds and their process and the types of advisors that they work with. There are over 300,000 registered advisors in the United States, and Dimensional works with under 5,000 of them. So it's only about a little less than 2% of the advisor population. So we're real excited that we're one of those firms that gets to work with Dimensional and enjoys that partnership. So Christian, welcome again, and really excited to have this conversation today.
Thank you, Tony. I'm glad to be back. I'm just glad I survived. We talked in the summer of 2020, I believe, and I'm just glad I made it to 2022. Some things have gotten better. Not everything's gotten better. Of course, we may touch on that, but thank you for those kind words about Dimensional, our track record. I think we're going to get into in our conversation, maybe part of why that track record exists, how it's come to be. But I'm really glad that you credited the advisor model for that successful experience that kind of confident, dedicated investors had through the global market crisis. I think the same thing has kind of been replicated in the last couple of years in 2020, certainly with the dawn of COVID. It's the advisor that Dimensional believes is absolutely essential, more important than Dimensional, to client outcomes and client success. And that's why we love partnering with firms like yours. So thank you for having me back. Pleasure to be here.
Awesome. Well, thanks, Christian. That's absolutely right. You can have a great investment team and philosophy, but you have to you can't sell when everyone else is, you don't want to sell low and buy high, as simple as that sounds, right?
Most people want to avoid that. It doesn't mean everyone doesn't do it, but yes, absolutely.
Yeah. The execution of it's that's the challenge, right? So, well, great. Well, Christian, can you maybe just refresh our viewers and listeners today, kind of a little bit about Dimensional and, what makes it unique, how, you're not just indexing and yet you're not trying to outguess the market. So how would you kind of describe that more dynamic approach, that maybe that middle ground that you guys take, and what makes you guys unique?
Absolutely. I think there are a number of things that truly set Dimensional apart. And you're absolutely right. I think the two largest, most obvious, most visible categories of how people choose investment managers, and these days that's usually through a mutual fund or an ETF, are those two big categories. The so-called indexing world, tons of ETFs are based on indexes, tons of mutual funds are based on indexes, and then the so-called active management world. And active management, again, I'm going to define as essentially trying to avoid bad returns and only seek out good returns, and do it through concentration, being really selective in the companies or bonds that a strategy wants to own, or through timing. Again, trying to avoid bear markets, to kind of put it into kind of blunt terms, and only harness markets when they're going up, engage bull markets. Those to me are the traditional definitions of what managers do: either have a forecast of the future and make a lot of changes to try to pursue that forecast, or essentially accept market level returns, accept those market level returns that indexes describe. And we may get into that in more detail. But Dimensional does not fit into either of those categories. That's what makes us unique. And I'll share a couple, not all, but a couple of reasons why that is. Number one, Dimensional is old enough. The founding of Dimensional is way back before indexing investing was really a revolution that was accessible to retail investors, to clients of financial advisors. This is back in the 70s and the early 1980s, where most investments were going to be through concentration and timing. Most investors were not going to have a wealth manager, they were going to have a broker, and that broker would put them into the bonds that they happen to have, at their brokerage house, or the stocks that their analysts were recommending. The revolution of indexing was to say, hey, we can just hold the entire market and do so in a really parsimonious, really cost-sensitive way, where you don't have a lot of activity. Now, before Dimensional was founded, the founders of Dimensional were instrumental in the first efforts at indexing. These were not public investments. They were not, say, the really famous early pioneers of indexing we've heard about, but rather indexing for corporate clients, often addressing pension obligations that corporate clients had. So the founders of Dimensional, Rex Singfield, David Booth, they were instrumental in very early efforts to explore this alternative to indexing. One of the things they realized in those early efforts was indexing is a good idea, but indexing has limitations. Indexing itself creates frictions and constraints. It creates its own set of expenses that can reduce, not increase, returns. So the real founding of Dimensional was to say, the reason Dimensional was founded was to say, hey, we can form investment portfolios that are not beholden to any index. That is, we don't have an outside index publisher telling us what we have to own and when we have to own it, nor do we have to have that forecast. So we can kind of sit outside of both of those categories. And we can do that for two reasons. One, we're using the academic evidence that drives where returns come from. We may touch a little bit more on that. But two, most importantly, Dimensional is not competing at a retail level with those passive options or those active options. Rather, what we're doing is we're always working with the client to define their need, and based on client need, we'll then work backward to determine what the investment product should hold, what we would more technically call the mandate of that investment strategy. Do you want to hold only US stocks? Do you want to hold global stocks? Do you want to hold only municipal bonds? Do you want to hold corporate bonds from around the world? Those are all kind of what we would call different mandates, different definitions of what the client wants to hold. Once we've got that relationship with a client, we don't have to compete with active managers. We don't have to compete with index managers. Rather, we can just apply academic research to hold as much as possible, be diversified, but still pursue returns that are higher than what we would get if we simply held the market. And again, to me, what makes us unique is that we've never competed on a retail level. We don't try to attract retail assets. We primarily work with institutional clients, clients who, again, very often are managing pension obligations, investments that are going to benefit, beneficiaries down the road, or wealth managers like yourself who are working with clients in essentially separate accounts. Again, bringing all those assets together in particular mandates that can play their position, but pursue higher expected returns. And that pursuit of higher expected returns is where that terrific track record comes from. And again, like you've already pointed out, but I'll reinforce it one more time, that track record does, I think credit does go to Dimensional's care and kind of fortitude in maintaining those dynamic investments over time. And maybe we can get into what it means to be dynamic in a minute. But a lot of the credit does go to the end investor. The only reason those outperformance track records exist is because we've been managing over long periods of time investments for end clients. And again, it's education, it's perspective, like what we're talking about today, that we believe is essential for their fortitude and for their success.
Yeah. Yeah. Awesome. So Christian, when you kind of talked about, pursuing better expected returns or improved expected returns than just indexing. So how would you describe that Dimensional goes about that for our viewers today?
So an expected return is really an academic concept. The concept is saying the following: what can we observe in markets today? Really in asset prices today, the sum total of all of the prices of, let's take the stock market, of every option in the stock market. So every company that's issuing stock, what can we observe in prices today that can give us an idea of what to expect in the returns of those stocks going forward? Now, as we've already talked about, if I index the stock market, that is hold everything essentially at index weights or market weights, there's one market return that I can expect minus the fee it takes to get there, right? So every indexer can only approach market returns really axiomatically. They cannot exceed them because they still have costs. They have to run the money. They need to pay an electricity bill, all of that stuff. It may be really cheap, but it's never going to exceed that return of the market. So what Dimensional does by looking at expected return, not just of the entire market, but indeed the expected return of every option in that market, we can look at the price today of every single stock, and that gives us an idea of what we can expect its return to be in the future. Let me put it another way. I can take let's say there are 5,000 stocks in the United States. That's not a bad number, depending on how you define a stock that's traded enough to have a price every day. Not every security is priced every day. We may get into that. But if I look at all those 5,000 stocks, using academic research, I can observe the price today of those 5,000 stocks, and I can sort all of those stocks based on price and some other metrics to get a sense of whether that stock, whether I should expect it to have a higher return or a lower return than average. So these are differences in returns of stocks. The one key thing I'll add here is this pursuit of expected return really only works if you hold big baskets of stocks. If you sort all of those options, all those companies, and you simply take the single number one company that appears to have the highest expected return on that market day, I'm not diversified. I only own one company. So what I'm going to get when I hold that company is a ton of idiosyncratic exposure to the success or failure or future fortunes of that company. Hopefully it's great, but of course we all know that companies sometimes fall on hard times. Companies can go to zero, companies can expire, companies can liquidate, right? So I'm exposed to a lot of what we would call idiosyncratic risk, idiosyncratic uncertainty of that one company. But if I can instead hold 5,000 or maybe even 4,000 or 3,000, be a little selective, but still hold many, many, many stocks, that's where I can expect this difference in future returns. Again, what we call expected returns. So it's by looking at the price today to give us a sense of what we can expect tomorrow. Now, we don't consider that to be a forecast, because I'm not saying I expect this one company to do better. I'm not saying I expect interest rates to be exactly at X in exactly 2 years. I'm not saying I expect GDP to go up by this amount or sales to go down by this amount. Those are all the forecasts that kind of traditional active managers do. Rather, all we are saying is every day I want to look at price, give me a little bit of a hint about what I can expect in the future. And if I can hold lots of those stocks, look at the price every day. And that's a key idea because, of course, what happens in the stock market every day? Some stocks go up in price, some stocks go down. That's a new day of information that gives me further information about expected returns. So in theory, dynamically, I can potentially change the amount of what I hold for every company in my portfolio, in theory. Now, every day, to be cost effective, I'm probably not going to want to transact in every company in, say, a portfolio of 500 companies. That would not be cost effective. But every day, I do want to look at the new price because capital markets every day deliver prices. And this is I think this is a unique thing about capital markets that is not true for a lot of the other markets that we participate in. I'll give you examples in a minute, but the prices in capital markets every day are essentially free. We all pay nothing for them every day. If I want to know the value, according to the market, of some big famous stock, a Netflix, an Apple, or what have you, I can look it up online and I can see how the market priced it today. But there are a lot of other things, if you think about it, in our lives, our home, for example, or our human capital, the sum total of the maximum return we can get on our labor that are not easily priced. If I want to reprice my labor, that's an awkward conversation with my boss. I don't get a new price every day on how well I'm doing, whether I like it or not. Same with my house. Really, the only way to know what my house is worth, to truly know what my house is worth, sure, I can go on a website and get an estimate based on an algorithm, but the only way to truly have confidence at the value of my house today is to put it on the market and accept a bunch of bids. That gives me that picture. And of course, that is not cost effective. That is not free. At the very least, I got to hide, the family photos and clean up the place to get that price. But in the stock market and in the bond market, prices show up every day for free. They have a ton of information in them. And what Dimensional has done before anyone else did it in the early 1980s and continues to do it today in a dynamic way is every day look at the prices in the market today to give us a sense of what we can expect tomorrow if we stay diversified, own lots of different securities. And again, this is that key of long-term outperformance. Do that same thing over and over again for not just weeks or quarters, but ideally years. For as long as I want to own stocks.
Absolutely.
Every day I want to take a new picture, a new look at the prices and slightly adjust them and never say to myself, gosh, 2020 was tough, but 2022 looks even worse. I've got rising rates. I've got, kind of an interest rate, not interest rate rather, but an inflation kind of crash that might really freeze economic activity. There's the possibility of a regional war. There's the non-zero possibility of a global thermonuclear exchange. I want to sit out the next 2 years of the market. I want to dynamically forecast what's going to happen. Dimensional is never going to do that. Our perspective is to say the best source of a prediction of the future that we have is the pricing that capital markets do today because of how competitive they are.
Yeah.
So that's really the engine that drives every one of our portfolios, whether it's bonds or real estate securities or stocks around the world. It's to look at prices every day and bake that information in to what we're holding. And again, we're not using an index to do that. What we are using is the client need to do that.
Right. And Christian, I don't know how many trades occur on a daily basis off the top of my head, but I would probably gather that there's probably millions of trades that happen every day throughout the global capital markets through publicly, traded exchanges. So that's a lot of trades, right? People are coming together voluntarily. They're establishing a sell price and a buy price, and they're coming together. I mean, that is a lot of information, right? And information too moves so quickly today, right? So rather than trying to be faster than information is available, let's, like you're saying, let's harness that information and knowing what types of data points or factors have been statistically significant over time. So I think the other thing that comes to mind, Christian, is would you say that it's accurate to say that you kind of almost maybe you start off with the index? So for example, in Dimensional small cap index, or small cap institutional fund rather, you start off with the small cap index, but then you are looking to, basically improve the holdings within that, right? You're going to narrow down that index, right? You're going to look at size, price, profitability to kind of get to a better basket of small company stocks. Do you want to, I guess, would you describe, would that be accurate in your mind? And if so, do you want to maybe kind of touch on that a little bit?
I'll tweak one, totally accurate. I'll tweak one detail and maybe provide a practical example, because you kind of expanded that notion of how we use price. You kind of took us to the next level there. So I want to define some of those terms. Do we start with an index? You could argue that we do. That is to say, what we really start with is a definition. What's a small cap stock? And so we're really not going to look to a commercial index publisher to do that. What we're really going to do is look at academic research to say what tends to be small cap stocks, what tends to be large cap stocks. And we will start with that really big kind of definition of all the possible small cap stocks. I think the key difference between us and an indexer is that an indexer will look to that commercial benchmark to tell the asset manager, give me the name of the stocks I need to own. And then, and of course, what do markets do every day? Markets change, prices change. Sometimes what started out as a small company, a small cap company, meaning its price times the number of shares it has out in the world, that's the sum total of its value according to the market. We would call that a market capitalization. If the stock price goes up, well, that small cap stock starts to become a bigger stock and maybe eventually becomes a large cap stock. And again, pretty much any story that we hear of a company that goes from kind of nothing, just kind of a twinkle in someone's eye, to a successfully capitalized enterprise, to a really thriving success story, that company probably went from a small cap company to a mid cap company to a large cap company. That is sort of the path that successful enterprises in capital markets take. An indexer every year, sometimes every quarter, is going to look to the index to tell me, do I still own that company or not? And then once a year, maybe once a quarter, they'll have to change in and out all of the companies they need to own to match that index. Dimensional never goes to the index provider to tell it to what to own, because we don't want to update that picture once a year. We want to update that picture every day. Because again, prices don't change once a year. The market is open, pretty much every business day in the business week with a few exceptions. So we want to update those positions, potentially update them every day. That's why I would say, yes, we do start with kind of a big list of everything we can own. But then, like you suggested, we're going to use more information to be even more selective. So we're not going to stick just with that original index list. We're going to write our own list. And we're again going to look to prices. And you mentioned some of these other metrics we use. All of those metrics, I'm going to leave out all the technical accounting details. Suffice it to say, when we talk about value or growth, when we talk about a high profitability or low profitability company, these are additional metrics we use. But all of those metrics with some additional measurements, they still all track back to price. All of those metrics still change based on the price that securities have every day. So potentially all those considerations will change every day. So yes, we can get a little more selective. Again, with made up numbers, we might start with 500 potential companies, but end up with something more like 350 or 360. Why do we hold those? Because we believe those have a higher expected return. We believe those are going to behave like equity stocks. And those are the ones that we want to favor, not only in what we hold, but then this is the last level I'll go to before I'll let you step in, but the ratio at which we hold them. Yeah. So even though we know we kind of want to hold as much as we can, what we do want to do is we want to favor those stocks, even in a more focused basket, that have higher expected return. What tends to have higher expected return? Well, it's smaller capitalized companies on average. So what we will do is what we tend to do is own a little less of the larger cap companies and move that capital to increase our positions, sometimes doubling or even tripling what a natural market weighted position would be in those higher expected return names. And again, in theory, adjusting those positions every market day, especially on really volatile days where the prices change, because where is that volatility coming from? If we step way back philosophically, volatility comes from the market incorporating news. Sometimes it's good news, right? A company has a new product and it's selling like hotcakes. That's great for me as an equity owner. Sometimes it's bad news. Company's product has cooled off. It's no longer cost effective, and the revenues may expect it to go down, not up. All of that news, not just the hard news, but also the speculation of millions and millions of market participants, whether they know a lot or whether they know a little, I would argue is actually not really that important. It all ends up being reflected in the price. So especially when markets are volatile, we want to make sure that our portfolios keep up with that volatility, reflect the changes in prices, because every day there's a positive reward and expected return in those changed prices. And again, if we were beholden to an index, what we essentially have to do is sit on our hands for 249 days until that one magical day when the index provider tells us, drop company X, add company Y.
Right.
And that's a very different way of managing your positions. And at the end of the day, that's actually less cost effective than kind of being flexible and potentially trading every day and through every day, rather than waiting theoretically kind of once a year to make a lot of big dramatic changes to what you hold.
Yeah, I think that's a very important point and a valuable point, Christian, because that really kind of points to your flexible trading process. You're, like you mentioned, you're not beholden to an index. You don't have to reconstitute your funds if we hear that this large name company is now part of let's say the S&P 500, right? And that means when one company gets added, right, there's another company that's going to be removed from that index, right? And then all these, different index funds or ETF funds, they have to reconstitute, because that's the mandate of their fund. That's in their prospectus. They're required to do so. Obviously, if we think about this too conceptually, the entire world knows that this company is getting added to that, whatever that index is, and one company is going to be removed. So then you have these very large index funds out there that have to trade, and it's kind of like everyone knows about it, right? So they, and I'm sure that there's probably ways for them to mitigate that risk, but it's something to manage, right? Because if everyone out there knows that company X needs to be sold, they might be looking to try to purchase that company, maybe not at 100 cents on the dollar. They might look to offer 95 cents on the dollar or 90 cents on the dollar, because it's kind of they know the trade has to occur. So, if you think about that, and this is something more, I'm kind of curious about, but you would think that is going to require more administration by the index fund to try to manage that risk and try to sell that position more in a, I don't want to say a blind manner, in a manner which isn't a direct result of the forced reconstitution. But I guess I don't want to get too far in the weeds about that. But this points out that, the importance of having a flexible trading mandate, that you could trade daily if you wanted to. Right. So you're checking daily and trading when it's beneficial. But yeah, I think that's an important note that you made.
It's absolutely essential. I'll use a very compact analogy that I know every spouse out there can probably recognize. On what day are a dozen roses cheaper? February 13, February 14, or February 15? Which day is going to be the cheapest set of a dozen roses? There's no question it's February 15. Now, if you want to spend as little money as possible and have to sleep in the guest room, buy a dozen roses on February 15th, a day late. What's the difference, right? But of course, what everyone does is they pay the premium to tell their spouse how much they love them, and they buy those roses right on time with everyone else, and they pay a premium for that. What we would call that in the securities world, a liquidity premium. I got to pay someone to transact with me. I'm desperate, and all my counterparties know it because it is Valentine's Day. And so what Dimensional is doing essentially is saying, we want to buy tons of securities, but we want to pay as little as possible. The general principle of buy low, sell high. So if we can buy before it's in demand, well ahead of Valentine's Day, or after it's in demand, behind Valentine's Day, if you do that over and over again over the long haul, what happens? You buy low, you sell high, you experience not just the expectation of a higher return, but what we call the realized return, what actually shows up in your return in owning the strategies. You do that over and over and over again every market day for decades. And what accumulates is a very strong track record of, just like you said, not trading when the crowd is trading, but rather being flexible and only doing so when it benefits the shareholder. Because at the bottom line, if you are an indexer, it's your job to track that index precisely, even if it means paying a premium. Why do they get away with that? Because they know every other indexer they're competing with is also paying a premium. So in a sense, investors who use index funds never kind of notice or not sensitive to all those little premiums that indexers are paying in order to as closely as possible match the performance of that index. That is what they are judged by. Dimensional never positions itself to be judged by a commercial index. You can do it, you can compare the results, but our goal again is focused on the client need and pursuing higher expected return. It is not preoccupied at all with what a commercial index has to say, and that benefits shareholders of a dimensional strategy.
Yep. No, that's great. And obviously there's definitely a lot of areas in the market that, at Fidato Wealth, we, believe that having a fund that's managed like how you guys manage it provides a benefit that shows that long-term benefit. And that kind of brings kind of the next topic that I'd like to chat with you about is one of those areas that I think it's really important to not index is emerging markets. And so we look at Dimensional's Emerging Markets Fund. It has a phenomenal long-term track record, but a couple of really important things that your team updates us on, provides us regular updates. But one of those updates was about the Emerging Markets Fund, and a couple of quick facts about Dimensional's Emerging Markets Fund. As of January 31st, 2022, Russian securities only basically made up 0.92% of that fund,
Right.
While the traditional emerging markets index fund held Russian securities that was equivalent to 3.32% of the total fund. So that is a sharp difference, and that's been the case with your fund since 2014 when Russia annexed Crimea.
Right.
Another quick fact is that Dimensional does not buy locally listed Russian securities but you get that exposure through depository receipts purchased on a couple different trading exchanges, and those depository receipts offer certain investor protections and liquidity benefits. And I know that also in January of 2022, you guys halted further purchases of Russian stocks in response to, the rising risks of the sanctions being imposed, which I think is really important. And I do ongoing investment due diligence and look at the funds that we utilize and kind of look at their performance. And I looked at the Dimensional Emerging Markets Core Equity Fund that we've been talking about with return data as of March 31st of 2022. And looking at the past 1 year performance, and this was through the Morningstar database that we utilize, but the 1 year return of that fund was negative 3.29%. So about negative 3%. But if we compare that to, for example, the iShares Emerging Markets ETF, that fund was down negative 13.7%. And even Vanguard's Emerging Markets ETF fund was down negative 8.9%. And furthermore, if we look at the 1 year difference, to me, that illustrates that importance of having that flexibility to be able to not just be tied to that index. But even, if I look at the 10-year return of the fund, now these returns are net of the fund expense ratios, but not net of management fees.
Mhm.
I think that's an important kind of disclaimer to mention. But the 10-year return was 4.17%. And again, you can compare that to either of those two indexes. And the iShares index fund for emerging markets was at 2.63% versus Vanguard's was at 3.34%. So that's solid, kind of that slight overperformance, if you want to call it, that you guys try to shoot for. But I guess this is a great example of how that flexible trading policy can manifest itself. But Christian, I'll turn it over to you. What are some of your thoughts on kind of this example that I'm discussing?
Yeah, I mean, honestly, where I would start is, hopefully this isn't pedantic, but just to zoom way out and just consider what makes emerging markets emerging at all, right? Why are some countries and the capital investment opportunities in those countries separated from an investment in the United States or an investment in what we would call developed markets like Japan, Germany, UK, so on? Emerging markets are just that. They are places where capitalism, capital enterprise, the legal traditions of contracts law and shareholder rights are kind of adolescents. They've been around a while, but they're maybe not quite as reliable as someone in their 40s with a mortgage, if you'll pardon the kind of family analogy there. Emerging markets sometimes experience incredible growth, up 30, 40, 50%. Not just as a whole, but individual companies, rather individual countries in emerging markets. They can also experience incredible collapses. Emerging markets, again, the capital enterprise in emerging markets have gone too close to zero at times. That is something that has happened. So we tend to set aside emerging markets because they have these kind of special uncertainties because of the youth of capitalism in those countries. And again, I would say Russia and China are both great examples of how those experiments can be successful, unsuccessful, go sideways, give us pause as investors over the last 20 or 30 years. So there's a lot of value that we add in kind of holding our own account, not just on what companies do we want to own. We've already kind of covered that approach, but what countries do we indeed want to invest in? So again, just like we talked about an index of companies, we are not going to look to an outside provider to tell us, here are exactly the countries that you want to own in an emerging market strategy. We're going to hold our own account to do that. Part of it is because, again, we want to protect the interests of shareholders in our strategies. We want to make sure that it's cost effective to access those markets. And again, you mentioned depository receipts, ADRs, like we have used for a long time in Russia markets. Again, rewinding a few years, you could access Russian markets directly at a Russian exchange using rubles to execute those trades, or you can use ADRs in New York and in London that are going to trade in other currencies. And to get exposure to a lot of the companies in Russia, ADRs are more effective. And a lot of emerging market countries tend to have very concentrated industries. If you look at some emerging markets, there's really only one sector that they represent. If you want to buy Peruvian equities, and Peru is an emerging market, you're basically only buying mining companies. That's the primary capitalized industry in Peru. That probably doesn't surprise anyone. So they're more concentrated, they're more idiosyncratic. So we can add a lot of value by, again, not following the herd, not following an arbitrary list of countries, but rather holding our own account. And the story of how we've looked at Russia, where again, we've dialed down that exposure well ahead of the unfortunate proceedings of the last few months, is an example of us looking out for the interests of shareholders. It's not an example of dimensional saying we have a magical prediction of geopolitical events in the future. Rather, it is an acknowledgement of, capitalism in Russia is not really turning out like we would like. Let's not be rash. Let's not go to a fire sale and liquidate everything overnight. We've already covered why we wouldn't want to do that. We would pay a massive economic penalty, or to be more precise, investors in the fund would pay a big penalty to do that overnight. Rather, we may say, hey, let's gradually reduce our exposure. And reducing exposure to one country isn't the big deal. Why? Because we're dealing with 22, 21 other markets out there. a lot of opportunities, lots of diversifying power there. So exposure to one particular market is probably not going to hurt us. And another example there, rather than saying we're going to sell everything tomorrow, we'll simply say, you know what, we're going to halt trading. We're not going to add any positions. We're not going to rashly sell. We're going to try to minimize the damage. And again, because our perspective is if bad news has happened, it's already shown up in prices. We've already realized that bad news. You want to put it in terms of pain as an investor. We've already experienced the pain of the bad news discounting those securities. So let's not make it worse by rashly trading out of them. Let's put a halt on the trading. Let's see what happens. And then maybe, you know, as new information becomes apparent, we can slowly get out of that position. Or, you know, if you want to be super optimistic, we won't say this about Russia, but about an abstract investment opportunity, maybe, you know, shareholder rights and surety in markets or access to markets goes back to normal, and you can kind of increase that position again. We have had good news stories of that in emerging markets over time, but there is a ton of value that we add by having the talented human beings at Dimensional look at, you know, what are the risks, what are the benefits of accessing these countries, these companies, these industries, and what's going to redound to the best interests of an end client who wants general exposure to emerging markets, but obviously doesn't want to have those really idiosyncratic risks to poorly performing countries or companies potentially in that asset class.
Yeah, that's great stuff. And I think it's important for kind of me to note too is emerging markets is a, you know, for our clients, it's a small position. It's meant for diversification. So for our clients in our moderate portfolio, the target weighting for emerging markets is 3.6%. So very small position, because like you mentioned, emerging markets offers opportunities, but there's also more risks, right? And you know, I think that's you know, I think there's multiple areas in the market where you know, having Dimensional manage those different risks and being selective and that patient trading. I think there's several areas that I can think of, you know, in U.S. equities and U.S. bonds and global bonds and international stocks and other very important area emerging markets. But I'd like for you to touch a little bit on how you guys manage your the bonds that you own within your bond funds. And the reason why is, you know, obviously inflation has been, you know, very high. It's been persistent. It's definitely one of the headwinds that we're facing at the time. And, you know, bonds can be affected by rising interest rates. And, you know, we use investment grade only bonds. We don't buy any non-investment grade bonds or bond funds for our clients, and you know, utilize you guys for all but one of the bond funds that we use because of the track record there that you guys have. But, you know, maybe kind of talk about, you know, how you guys manage risk within your bond funds. Obviously, bonds are kind of used to be the ballast against risk in on our client portfolios. So
the story of bonds is a really interesting one. You know, bonds conceptually as an instrument are older than stocks. Bonds have been around a lot longer than stocks have. But bonds and bond markets continue to evolve. And I just want to go right back to the most basic principles at Dimensional. The more we can see in prices, the more we can do with portfolios. And that's absolutely been the story of what we do with bond investments, what we target for the mandates of bond strategies. And like you said, kind of how we manage those risks going forward, what we do in bond strategies. And I want to argue they are just as dynamic as equity strategies. Sometimes for even me as a holder of both stocks and bonds, it can be harder to see because of the nature of bonds tending to have a lower absolute return, tending to be more sensitive to things like interest rates and inflation, not tending to be as exciting as stocks. But despite all of that, my perspective is that we have the same approach where we look to prices in the bond market to give us an idea of expected returns going forward. And we are going to be just as dynamic in looking to prices every day to give us a clue about what should we change, what bonds should we add, what bonds should we drop. Again, that same goal that we've talked about, to put kind of rough terms. We want to buy those bonds as cheaply as possible, and we want to sell them when they are at a premium and not at a discount. So how do we go about doing that? What we're going to do is look at prices in the bond market. Now, I think the bond market is something, especially for lay people, it's sort of harder to think about, because as we all probably know, bonds are typically talked about in terms of yield. That is, in terms of their relative return to their underlying value. I guess I'll also say, to rewind a little bit, what separates bonds from stocks is that bonds have a limited lifespan, right? They're born, they're initiated, they have a particular maturity, they exist for a particular period of time, and then the bondholders get their money back and the bond ceases to exist. Stock issues last forever, theoretically, as long as the company does, or at least have a value as long as the company has value. Because bonds have a limited lifespan, bonds are more idiosyncratic. There are more different kinds of bonds than stocks. The Coca-Cola company issues stock, and every share of stock, putting aside some obscure accounting issues, is fungible with every other share of Coca-Cola stock. When Coca-Cola issues a bond, that bond is unique, right? It's a Coca-Cola bond where the bondholders get their money back in November of 2040, not before, not after. So because of that variety of bonds, the marketplace is very different. And for a long time, it was hard to see activity in the bond market because bonds were very idiosyncratic. Most bonds were not traded on an exchange, a big room of people arguing where you could visibly see, you get reporting on all of the prices. Most bonds, 100 years ago, even 30 years ago, even 15 years ago to a point, were traded over the counter, essentially privately. Where if I wanted to own that Coca-Cola Novi 2040 bond, I had to pick up a bunch of bond market makers and find out who in their inventory has this bond. Many don't, one does. And then it's up to me to negotiate with that bondholder. And I don't have this high quality data stream of how have all the other shares of this bond traded. That literally doesn't exist. A big change to capital markets, maybe not in the headlines, but certainly in our industry, has been the TRACE database, where essentially, FINRA is essentially the self-governing board for securities trading in the United States. And FINRA wanted to add more transparency to the transaction of bonds. So the TRACE database is essentially, it is exactly like the ticker that we see on cable news of all the high volume stocks. It just exists for bonds. So what used to be a very opaque, almost sort of secretive activity of buying and selling bonds from inventory over the counter is now something where every day there's a big picture of the prices of a lot of these bonds. Now, again, not every bond is transacted every day. It is still sort of more lumpy and idiosyncratic in the stock market, but that is a big set of data that we can put to work. So that's a set of data that we put to work in determining, yes, potentially, if we have a mandate to own kind of medium-term bonds, 5-year bonds, we want to look at the prices of all of those opportunities. But again, just like with stocks, we can be more selective. By being more selective, we know that we can pursue higher expected returns. If I only own every bond in that index, that can be difficult to do, even for an indexer, again, because of the diversity of the availability of bonds. I'm going to kind of get that market-like return. But if I can concentrate, if I can focus only on the bonds that, again, looking at prices, what we would call looking in essentially to the difference between all the possible bonds in that space of the market, I can focus on higher expected return bonds. Bonds that I expect going forward are going to reward me more than some alternative. And we use that TRACE data to do that. That's allowed us to get a lot more expressive, a lot more specific in our bond strategies. I guess the one other thing I'll say about TRACE data is the other element of bonds, again, for decades, has been that because bonds are a little opaque, there's this tradition of using rating agencies outside, essentially, not really auditing, but rating agencies that will express an opinion on the credit worthiness of a bond, right? If I have two companies or two countries, there can be a difference in, to my mind, the likelihood that they will default. If I own a bond that doesn't absolutely guarantee me I'm going to get my money back, right? A company can default in such a way, and if they liquidate, I may be paid a little bit, but I may not get everything I was entitled to as a bondholder. That is the risk of holding that bond. That's why it will trade at a premium to what it will be worth kind of when the bond expires, because of that little bit of uncertainty. So the trace data gives us an ability to essentially increase the amount of data that we use. We don't only have to rely on those credit rating agencies. It turns out that the trace data, because it is what? Competitive market data that potentially changes every day, is a lot more forward-looking than those rating agencies' opinions, which usually don't change all that often. Usually the market is ahead of the rating agencies. That's a good example of the kind of data that we incorporate, again, so that each strategy is still playing its position, still focused on the mandate that is right for those clients. Some clients want, government debt that doesn't get older than 2 years, right? Pretty short, high quality government debt. Other clients want longer dated debt that is exposed to, say, the risk of lending to a corporation rather than to a government. More risky to lend to a corporation, but a higher expected return, right? Usually at a much higher yield, different return, different risk profile. Same thing is true across the board with all bonds. And that is what we are doing in every strategy. Look to prices every day, just like with equities, to tell us what dynamically can we change in our exposure such that, still staying in that kind of strike zone, we can pursue higher expected returns. And again, that tends to show up for disciplined investors in the long-term outperformance. It does, we're probably going to get into this next, it does pose a challenge in periods like we're experiencing right now, where those short-term returns, especially on particular bond strategies, look really, really dismal because interest rates are going up. And what does that mean? Essentially, it means these bonds, as they age, there's now competition from new bonds, and this bond paid me, 1.5%. Well, because interest rates have gone up, that new bond pays me 2.5%. You have to. This old bond is not worth as much as it was before because there's now an alternative that has a higher yield. That old bond, its legal structure, what I get paid, its coupon rate, that doesn't change. But the market is now going to discount it in a different way because of the change in the interest rate, kind of the cloud of competition around that particular bond. That can create short-term pain because on paper, I see short-term negative returns. But my philosophical view, of course, is that the same way that I'm holding stocks, not for what happens for one company in one quarter, one reporting period, even 1 year, but I want to hold a big basket of stocks, for my wealth for ideally 20, 25, 30, 35 years. If I can pass wealth on to my son, which I'd love to be able to do, maybe that goes to a 60 or 70 year time frame. That to me, that puts time on my side. The same thing I believe is true for bonds. Very few of us, I think, are owning a bond strategy to speculate on a change that's 1 year or 2 years long. Rather, like you mentioned earlier, we tend to be holding bonds for 3, 5, 10-year periods as a ballast, because even when they are discounted, that is still very rarely more volatile than what's happening in equity markets in either direction. So the bond strategies are still playing their position. There is a short-term pain of taking a look at how they've been discounted. But of course, especially with shorter dated strategies, it doesn't take long before, as those bonds expire, as they get traded out of the portfolio, that they're now replaced with newer bonds at a way higher interest rate that, of course, probably matches, inflation and interest rates going on, or at least approaches those rates. So to me, it is a short-term pain. Again, that just like I'm rewarded for bearing short-term pain in the stock market, I'm rewarded for bearing that short-term pains with the bonds that I own because they're still playing the position I wanted to have them in. That's why they've been in the portfolio in the past. It's why they'll be in the portfolio in the future. It can be often, I think, for lay people, it can be more tempting to speculate about the future of bonds because they know that governments control some interest rates, right? The Federal Reserve does control one rate. It's really only one interest rate it controls, the overnight rate between huge banks. The federal government, the Fed, does not control the T-bill rate, doesn't control the 5-year, the 10-year rate. Those are controlled by no one. Those are based on auctions.
By the market.
Right? If I want to buy a 30-day T-bill, I can walk into the Fed, into the Treasury and engage in an auction to buy those instruments. no one controls the price. It's controlled by the market. So
Yep.
the same way that we don't want to try to outguess the market and damage our long-term success with stocks, the same thing is true with bonds. It's maybe a little less intuitive. If we try to outguess what's going to happen with bonds, even when we think we know exactly where the Fed's going to set rates, we know exactly where inflation is going to be, so often we can be wrong. And if we're wrong by even a little bit, the cure can be worse than the problem if we try to speculate and get ahead of ourselves, even with our bond investments.
Yeah, no, that's a good point, because like you said, the Fed does set rates, but it sets one rate, and sometimes Fed policies their interest rate policies will influence how other bonds are traded, or other notes, or
for sure.
But sometimes they may not, or sometimes they may not immediately, or there isn't that guarantee that them changing that rate will necessarily change all these other bond instruments out there that trade. One of the things that talking to or kind of the DFA over the years, one of your team members kind of described, and I think this is important for our listeners to understand, is that about just kind of like how you guys look at the yield curve. So, like, for example, if a bond is going to pay, let's say, 3.5% interest, and it has to be a 5-year bond, right? But you could also buy a 3-year bond that also pays 3.5% interest. You guys aren't going to take any more risk than which is needed. So, obviously the two types of risks are the duration of the bond, how long the maturity is, right? The longer the maturity, the more risk. And the second is obviously the credit rating, or the credit quality of the issuing company or government. But you want to maybe just touch a little bit on that? I think that's really important, because that daily monitoring of that price information, and not trying to guess what the yield curve is going to do. Again, just harnessing that information to not take any more risk than which is needed.
Yeah, I think for a typical bond that's out there, or for popular media commentary on bond markets, they're looking at what do these interest rates look like if I hold the bond to maturity, right? Where I get my principal back, and we kind of measure what was the economic benefit of all the coupon payments, all the uncertainty that I bared. But just like you said, Dimensional does not hold every bond it owns in a fund to maturity. Far from it. Usually, most often, if you think of sort of the matrix of every possible transaction that I can execute with all the bonds I hold, how long do I hold them? What's the benefit for holding them, or the negative for holding them? That's what we kind of call looking into the term structure, the kind of the matrix of all the possible options inside of that portfolio. And very often there's a higher expected return, just like you said, for buying at one maturity and selling at another before these bonds would expire. So again, we're not leaving anything on the table when we examine, and this is a true material statement. Every day, the talented PMs in our fixed income desk are looking at the possible futures of every holding, and how long we would hold it, the possible expected return of potentially transacting in every one of those positions, and rerunning that data every day. Now, like, our talented PMs are really talented, but they don't do this stuff in their head. Of course, they are aided by a computer model that's constantly recalculating this. But this is something that I love to point out, because I think sometimes, again, investors get concerned when they hear about markets moving faster than ever, algorithms and computers being involved, and is there a human being at the wheel? Is Dimensional just a big algorithm that kind of no one is paying attention to? And the analogy that I love to use is the following. If I want to design a house from scratch, I want to hire an architect to do that. I want to hire a human being who can hear my goals. I want a 2-car garage. I want to have a playroom over here. I want a human being who can hear my goals and make sure that we achieve my goals. But I'm not disappointed when that architect turns around and uses a computer to design and manage the structure. And that is exactly what our PMs do. Yes, we have algorithms that are absorbing all this price data, because it's way more bond math than any one person wants to do in a market day. But there's still a human being that's looking at those results and saying, yes, this is sensible. Yes, this makes sense. Yes, this maximizes the likelihood of success for this particular mandate. And when something doesn't make sense, when a bond price is trading in a really unusual way, we've got a human being that can send up a red flag. And again, that's not to say that we're going to speculate on that unusual information, but maybe the easiest example is we just would hold and not transact on that particular issue until we can find out what's going on with it. So to me, there is a lot of complex math going on in how we optimize these portfolios, just like there is on the equity side, but there's always a human being to go along with all this computer activity. And to me, it is a marriage of those two kind of parties, not one or the other, kind of working alone, if that makes sense.
Yeah, no, I think that's really helpful, because I think it's an important talking point for that reason that you mentioned. I think that sometimes people think, oh, well, bonds are, going to go down. If only every asset class just went up, right? But and they may go down, right? But that also presents rebalancing opportunities, right? And I think, kind of maybe the concluding topic is like kind of talking about like, how does all of this, all of these economic headwinds, inflation, geopolitical concerns, what if there is a recession, all that thing. I think a lot of times people just want to know, how does that impact, them? So I think it's kind of a great concluding topic. And, I guess I want to get your thoughts on that, Christian, before I have some thoughts as well, but love to hear your thoughts.
I think it is a totally natural wish to avoid the pain of, as an investor, there are other forms of pain in a recession or a downturn or stagflation or buying gasoline at the gas pump. There's other forms of pain in our lives, but we just compartmentalize our role as an investor. There's a lot of pain in the possibility of a big recession, of a big downturn, where all of my securities are discounted, not for weeks or months, but for years. And there's a lot of pain in actually experiencing that. But I think there's a lot of benefit to, kind of thinking twice about responding to that pain. So a couple of thoughts for you, and we'll see maybe what you want to press into in more detail. The wish, of course, and this to me is the wish that active management, is predicated on, is avoiding that pain by hiring an expert who can read all the tea leaves, who can connect all the dots and say, this is a time to get out now. Let's get out while we're high. Let's not be the greatest fool. Let's not be holding the bag when markets crash. And then we'll wait for markets to crash. And as soon as they've hit rock bottom, I'm going to tell you exactly when they hit rock bottom. That'll be the time to get in, because that is, in a word, buying low and selling high, right? That is getting out high and then waiting until they're discounted. But I want to argue that active management is kind of like a painkiller, dangerously addictive and ultimately not successful. We want to avoid that pain of negative returns and only have the pleasure of positive returns. But in a competitive market, in competitive stock markets, in competitive bond markets, if there is a really obvious conventional wisdom about what is going to happen tomorrow, it is baked into prices today. And I think we have to be humble, not only us as individual investors, but also an asset management firm like Dimensional, to say, we have opinions, we use academic research, we're really smart people, but the market, because of the way it incorporates a ton of information in a chaotic, non-linear way where no one controls it, on balance, that's probably better at handling these uncertainties than we are. There's a great wish to avoid that pain in the short term of experiencing, again, negative returns or discounted values, or, crossing some magic number in my, in my investment, in the total wealth of my investment account that I never wanted to cross, or at least, like we say, we don't want to cross it, an even number of times. If we cross it an odd number of times, it's okay. That's painful, but the evidence is the best way to withstand those periods is to have an investment plan that's set up. So I want to be diversified. I want to own US stocks when the US market is going well. I want to own emerging markets when emerging markets are doing well. In the last 10 years, as I'm sure all of your clients know, US stocks have knocked the lights out. And emerging market stocks have been relatively disappointing. I mean, 6 or 7% is not terrible, It wouldn't kick it out of bed for eating crackers, but 23% a year, that's great. That's what US stocks have delivered. But as you remember, we can rewind 15 years to a period of time where US stocks were pretty moribund and emerging markets were delivering 20, 30, 40% in some countries every year. Those were the returns people wanted. Trying to chase that puck in capital markets, either seek out gains or avoid losses, is really dangerous. To me, it is like a painkiller. We can get addicted to it and it does not help us. Let me ask one question sort of as a thought experiment for everyone. How long was the last bear market that we experienced in 2020? How long was that bear market from peak to trough or trough to peak? 33 days.
Yeah, it was short-lived.
It was a 33 market day long bear market. I believe the shortest we've ever experienced. We all remember the uncertainty of what was the shape of the COVID recovery going to be. Was it going to be a V or an L or a W or a check plus? All these different predictions of what it was going to look like. Because if someone can accurately predict that, well, then they know how long to wait in the sidelines. They can, with confidence, avoid that pain of watching the value of your investments evaporate. And we naturally have a lot of emotional attachments to that worth. That is all equity that we have earned through hard work, sweat, or smarts, or luck, perhaps. But again, I want to argue markets go down quickly. They go up quickly too. We don't get a postcard the day before markets are going to deliver 2.5%. And 2.5% returns in a single market day are not that uncommon. If we miss out those days because we've kind of made that classic flight to quality, we may feel better, but probably we are not going to achieve our goals, because by the time it's safe to get back in the water, capital markets are not looking back. They may never get back to the discounted level that you exited them. So I understand that wish to avoid the pain, but our perspective at Dimensional is, and this is why we want to work with advisors, if the client has defined their goals, and if they have an investment plan that can achieve those goals when markets are doing really well, and let's be honest, especially if we've had a home bias to US stocks, like most of us have, markets have done really well for us if we stuck to it in 2009 and stayed in our seat. That was the longest bull market we've ever had. So it wouldn't surprise me, if just the way the tumblers shake out, might have 1 or 2 years that are, kind of sideways or even possibly negative. We look at the historical data, we see that those happen all the time. But how deep, how persistent are they? Usually, if you look at that historical data, if you give it 2 or 3 or 5 years, markets recover, the green shoots return. And maybe this is the last thing I'll say before handing it back to you, Tony. I really believe, as capital investors, it helps to have a dose of optimism. It helps to have an underlying confidence in the human experiment, or maybe the American experiment, or American capitalism, international capitalism. Kind of characterize it however you want. If you don't believe in that positivity and that engine of producing better lives for more people and rewarding capital investors as a result of it, on some level, being an investor may not be a great natural fit for you. And I want to share this quotation with you that I love about the risk of interrupting how we invest. So Charlie Munger, as I'm sure a lot of your clients recognize, has kind of been Warren Buffett's partner in crime for, I think, 60 years now at Berkshire Hathaway. And he has this great quotation about compounding. I loved your episode on compounding a few weeks ago. And Charlie says, the first rule of compounding, no unnecessary interruptions. And I believe for us as investors, I think it's really good way to think about investing is it is an endurance sport. We want to start doing something in a sustainable way, and we want to keep doing it and never stop. We want to have an investment plan that allows us, if we're still contributing to that plan, to contribute when markets are really bad. Why? All those prices are discounted. That's a way we can take advantage of the market. Or if we are drawing down from our wealth in retirement, we can still draw down with confidence that we've got assets that we believe are going to continue to compound going forward. So I just love that mental image that just like an endurance athlete running a marathon, we don't want to stop. We want to set a pace, and we want to have a plan that allows us to keep going, even in the face of short-term paper losses that do feel painful. But there's a premium associated with being willing to bear that uncertainty. And investors through 2008 and 2009, investors in 2020 and 2021 they realized that benefit of withstanding short-term uncertainty. And that's what we always face in a recession. That's not that really wasn't a quantitative argument for you, but I
No.
think more an intuitive argument about
Mhm.
why we don't need to fully capitulate to the idea that I can't be successful going forward as an investor.
Yeah, no, I think that's spot on, Christian. And right, that, without that uncertainty, there is an opportunity. And there, when we look at the evidence, there isn't really, there isn't like this person that has a long-term track record of being able to time when to get out and then when to get back in, right? Which, you got to get both of those things right. So there isn't that data, but conversely, though, or opposing that, there is data to show that often the best days in the market occur after some of the worst days,
Right.
and that returns are concentrated. There are certain days in the market where if you're not in them, it's going to drastically, reduce your overall return. So those are all really, really good points, and I really appreciate you kind of sharing that, with our audience. I think that's really helpful. I think a couple things from my perspective, just to kind of maybe piggyback on what you were saying, is, that diversification. If I look at our portfolios have 14 different funds that each have a high degree of asset class purity. And the real estate fund that we use is up 13.5% at this particular moment over the past 12 months. That does not include our management fees. There's other funds that are up 6%, 5%, 4%. So, by having that and then utilizing, right, a disciplined rebalancing process. So right now, if we have a client that's taking distributions for their retirement income needs, we're going to be selling off the positions that are up. There are certain positions, while there's one fund that's up about 14%, there's another fund that's down 14%. So conversely, if we have a client making a contribution, we're going to be buying some of the asset classes that are down at the moment, right? And, in 12 months, it might be flip-flop, but that's kind of that patience, being very patient, and really, I think the key for us and our role is to educate our clients that they have patient capital, and most of them know that. But like you mentioned, there are recessions, but the average recession going back to 1950 averages 11 months long, but the average expansion averages 67 months. So while recessions are painful, expansions are way more common and way more powerful. We can't have those expansions without recessions. And by no means am I making any sort of prediction in the market. We do have headwinds to navigate. Sure. Being diversified, I think, is critical. I think, one of the things that we've been focusing on with our clients is, I've been using the term, let's take a look at the state of your personal economy. When we have a client come in and we look at their investment plan, but also look at their financial plan. And I could think of a recent scenario where somebody's been a client for a little over 11 years. And if you look at kind of the overall trend, this is just a little dip. You kind of have to keep that big picture in mind. But then looking at their plan probability of success, in this particular case, their plan had a probability of success of 99%. So, they were, they know the situation they're in, but these reviews help reinforce that. They know that their plan is overfunded, quite frankly.
Right.
So just really, I think, kind of focusing on that education, helping your client understand the strength of their personal economy. If their personal economy has any weaknesses, how to address it. But I think we kind of know we can only control what we can control. The diversification, the flexible trading, that using that academic evidence-based approach, the rebalancing, having an investment plan that's tethered to a financial plan that's based upon their life expectancy, inflation, taxes, what they want to spend. and really managing it, that I think is really important. Tax planning, if I didn't mention that, what can you control, and investment planning is very important. It's kind of the gas that fuels the car, but we also have to manage total wealth, right? What can we control? What opportunities exist today? And there's opportunities, right? I'm sure, like a lot of the other advisors you work with that are focused on comprehensive planning very deeply. We have a playbook. We have a playbook for when the markets go up. We have a playbook for when the markets drop. Markets drop, maybe we can accelerate Roth conversions, or there
Right.
other different things. So I think that's really, I would probably say, the biggest thing that I think is just really understanding your personal economy, and really at the end of the day, it's inflation's challenging, gas prices are challenging. That's really tough for maybe somebody that's earlier in life. They haven't accumulated the wealth that like our clients have, where they have patient capital. So there's challenges out there, but that's why we can help our clients do other things like charitable giving, or helping out family members, really helping them kind of make the most of their decisions, and being able to utilize their assets in whichever manner they see fit. But for some of them, they have goals like that to help family members or help others in need. So it's I could talk about this well beyond the hour that we were supposed to keep this within, but that's I appreciate your flexibility with that. Well, Christian, anything else that you'd like to add before we conclude?
No, I mean, I mean, I'll just say to respond to your perspective there, I totally agree. And I think, especially in times of a lot of change, whether that's within people's portfolios and the valuation of their investments, or just in the world at large, good or bad, what I've seen with all the advisors that I work with, the change more often is going to come from within the client than from without the client. The change is more likely to come from their goals, what they want to do with their wealth, a change in their perspective on charitable giving, or how they want to, kind of transition wealth to the generations ahead of them, rather than what's happening with the yield curve, or what's happening in emerging markets, or what's happening to FANG stocks. All that stuff is important, but to me, it's what's happening within the life and goals of the client. That's where the advisor really delivers their value. And I think that has a bigger impact on people's success or failure down the road than a lot of this stuff that happens in capital markets.
Yeah, agreed. And I'm really grateful though that we've shared some of those more specific things that you guys do, because I think that's helpful because of all the headlines today. But yes, it comes down to just what you mentioned. What is that client? What's important to that client? What is their personal economy? And educating them. And if that's the case, that their personal economy is strong, that this external economy may not be convenient, but may not affect their personal economy long term, I think is really at the end of the day. And keeping this, most clients want like kind of a, let's say a high 30,000 foot explanation, and not talk about yield curve, but but I think this will help as well. So Christian, I can't tell you how much I appreciate you and you sharing your knowledge, with our clients and friends of our firm that'll be watching this. So have a lot of gratitude for you and the team at Dimensional. So thank you very much. I've really have enjoyed this.
Well, thank you, Tony. I mean, thank you for your partnership with us, and thank you to anyone who is a Dimensional shareholder in a Dimensional strategy. Thank you for your business. It's why we exist. And I really appreciate being back. Thank you.
Awesome. Thanks, Christian.